Hello and welcome to today's Explainer. We are going to take a calm, structured look at the Friday trading session for the Indian equity market dated July 10, 2026. As a financial educator, my goal today is to help you decode exactly why we saw such a strong recovery to end the week. We will look at the data logically, step by step, so that the underlying market structure becomes absolutely clear.
Here is the agenda for our top-down approach today. We will cover 1. Broad market recovery. 2. Top sectors and stocks. 3. Earnings and global cues. 4. FII and DII activity. 5. Technical outlook and levels. And finally, 6. Triggers for next session.
Section 1. Broad market recovery.
Well, after a week heavily impacted by geopolitical news, the market finally managed to snap the selling pressure. The Nifty 50 closed at 24,206.90. That is a very solid 244-point gain, or just over 1%. Opening with a gap up, the index maintained its strength all day, showing that buyers were completely willing to absorb any intraday profit booking.
So why exactly did the market close in the green? Multiple positive factors aligned simultaneously. First, corporate quarterly results regained control of the market direction. The TCS results beat expectations, shifting our focus back to execution. Furthermore, yesterday night, we saw lower crude oil prices and a weaker US dollar. Add in broad banking participation, and you get a very healthy environment for buying interest.
The health of this rally is clearly visible when we look at market breadth. On the National Stock Exchange, we recorded 2,104 advances against just 876 declines. This means roughly 71% of all NSE-traded stocks advanced. It proves this was not just index management by a few heavyweights. Rather, there was genuine, widespread buying interest across mid-caps and small-caps as well.
Moving to Section 2, Top Sectors and Stocks. Let's look at the micro action to see exactly where the capital flowed. Consumer durables led from the front, surging 3.7%, strongly supported by Titan's encouraging business update. The IT index advanced 2% and metals were up 1.5%. But notice the bottom of the table. Defensive sectors heavily underperformed, with FMCG closing nearly flat at just 0.1%.
What we are seeing here is clear capital rotation. Investors were actively moving their money. We saw massive short covering and momentum in PSU banks. Indian Bank, for instance, jumped nearly 9.8% as investors moved down the risk curve. Conversely, we saw clear profit booking and long unwinding in defensive FMCG positioning, in names like ITC and Britannia. The market was actively seeking growth over safety.
Section 3. Earnings and Global Cues.
Let's look at the specific fundamental catalysts. The primary domestic driver was the TCS Q1 FY 2027 performance. Yes, the overall revenue beat expectations, but the market was laser-focused on one particular metric. Their annualized AI revenue increased 13.6% sequentially to reach exactly $2.6 billion. This specific figure gave the market confidence that artificial intelligence is finally generating tangible, measurable revenue rather than just being a story for the future.
On the international front, global cues were highly supportive. Yesterday night, Brent crude cooled to the $75.8 to $76 per barrel range. This happened as technical discussions between the US and Iran continued, which reduced immediate geopolitical panic. A cooling crude price is incredibly useful for investors in India, as it directly reduces our imported inflation risks, eases pressure on the rupee, and supports corporate margins.
Section 4. FII and DII activity.
Now, a rally is only sustainable if the big institutions are bringing fresh capital to the table. Notice the combined institutional support here. We witnessed clear FII buying, with foreign institutional investors purchasing a net of 2,063.72 crores. At the exact same time, we saw solid DII support, with domestic institutional investors buying a net of 2,019.68 crores. When you have thousands of crores in simultaneous buying from both sides, it gives immense credibility to this recovery. This was real cash market demand.
Section 5. Technical Outlook and Levels. Let's map out the technical levels. Understanding these boundaries will be highly useful for investors planning their allocations for the week ahead. For the Nifty 50, the immediate support is now clearly established between 24,000 and 24,100. The CMP must hold above the 24,000 psychological mark during any pullback to maintain this positive structure. On the upside, immediate resistance is at 24,300, and a higher supply zone sits between 24,550 and 24,550.
Looking at the financial sector's strength,
Bank Nifty closed strongly above the 58,000 mark. Importantly, this upward move was backed by total open interest rising to nearly 9.38 lakh contracts. When an index rises alongside increasing open interest, it strongly suggests genuine long buildup by market participants, rather than just temporary short covering.
Section 6. Triggers for next session.
Finally, we have major macroeconomic events lined up that we must carefully track. On Monday, India will release its CPI inflation data. The composition of this print will directly dictate RBI monetary policy expectations and domestic bond yields. Following that, on Tuesday, the U.S. will release its CPI data for June 2026, which will heavily influence the U.S. dollar and global technology valuations.
So the crucial question for all long-term investors to ponder over the weekend is this. Will the market sustain this aggressive buying interest when we open on Monday morning? Or will unresolved global cues trigger a fresh round of profit booking at higher resistance levels? The institutional positioning is cautiously constructive, but discipline remains essential. Thank you for joining today's explainer, and I hope this structured review proves highly useful for your market planning.